Rising interest rates have been making all the headlines throughout 2023, but these aren't the only changes going on right now that are having major impacts on the commercial real estate industry. And aside from issues that investors are having with servicing debt and refinancing maturing loans, there are a few big things that are impacting the operations of commercial properties today and affecting revenues, expenses, and the capital raising process overall. So in this video, we'll talk through 3 of the biggest issues that are impacting commercial real estate right now, aside from rising interest rates and the effects that all of these things are having on the real estate industry today. So the first thing on a lot of investors' minds today is a result of inflation, but also the amount and the magnitude of natural disasters that we've seen over the last few years, and this is the significant rise in property insurance premiums among essentially all real estate product types. In 2022, Hurricane Ian became the 3rd costliest weather disaster on record, resulting in over $67 billion worth of damages, which was almost 23% higher than the cost of Hurricane Katrina back in 2005. And in total, according to the National Oceanic and Atmospheric Administration, 2022 saw $18 billion plus events that cost insurance companies a cumulative $165 billion, which was the 3rd highest yearly inflation-adjusted amount since 1980. And these costs and the associated payouts that insurance companies have had to make to cover these losses have caused property insurance premiums to skyrocket in many markets across the country, which is having material impacts on operating expenses for many commercial property owners. While property insurance premiums have traditionally risen by about 2 to 3% per year, according to Moody's Analytics, commercial real estate investors have seen insurance costs rise by a compound annual growth rate of over 7.5% since 2017. This has resulted in insurance costs that are over 55% higher than they were just 6 years ago for the average commercial real estate property, but for properties located in certain high-risk markets, these investors have seen even higher annual increases, with a compound annual growth rate coming in at over 12% since 2017 in many major metros, including San Antonio, Dallas, Raleigh-Durham, Nashville, Austin, Salt Lake City, Los Angeles, and Houston, just to name a few. And according to the NMHC's 2023 State of Multifamily Risk Survey and Report, property insurance costs for apartment projects across the US increased by an average of 26% between 2022 and 2023. And according to a Marcus and Millichap report from earlier this year, insurance premiums now account for more than 8% of an average multifamily owner's per unit operating expense load, which was almost double that same figure from back in 2018. And this rise in insurance premiums is especially relevant for multifamily properties, where the operating expense burden falls entirely on the investor, and this is especially true for affordable housing deals with restrictions on rent growth that can make it difficult to catch up to big expense hikes on a year-over-year basis. And even for retail and industrial properties, which often include leases that call for the tenants to reimburse property owners for insurance premium payments, these leases will also sometimes include a cap on annual expense increases that can shift these premium costs back to the owner. And even if this isn't the case, this can have a major impact on overall occupancy costs for a tenant and the likelihood that they'll renew once their current lease expires. Some insurance companies are even pulling out of entire markets altogether, which is making properties in these areas extremely difficult to insure in the first place and can cause major issues with lenders when investors are trying to finance these assets, and can also significantly hurt the marketability of these properties whenever an owner is ultimately ready to sell. Now, the biggest impacts of insurance premium increases are obviously being seen in markets in states like Florida, Texas, and California, which have seen some of the biggest natural disaster-related damages over the last 5 years. But in almost all cases, what used to be a very small percentage of a commercial property's expense load is now starting to materially impact NOIs and property values as a result. Now, the next issue that investors are facing right now is one that's much more typical at this point in the traditional real estate cycle, and this is excess supply that's hitting the market right now. In the office sector, this has been a continuing trend over the last few years, and even with total completions during the last 12 months coming in at less than 10 million square feet per quarter, which is significantly less than the completion figures we've seen since 2019, net absorption was still negative over the last 12 months, and vacancy also increased to over 18%. At the same time, office leasing activity, which recovered slightly in 2021 and 2022, is now back down almost to 2020 levels, and major employment markets like San Francisco, Boston, Washington, D.C., Los Angeles, and Houston each saw over 1 million square feet of negative net absorption in the third quarter of 2023. Spreads between asking rents and taking rents for office product right now are also at their highest levels ever, with tenants on average signing leases at more than a 10% discount from asking rates. And according to the 2024 PwC and ULI Emerging Trends Report, over 25% of residents are now working from home in several major employment hubs across the US, including Manhattan, Austin, San Francisco, Washington, D.C., and Seattle. And the property type that could do no wrong for a very long time, multifamily, is also starting to see the impacts of excess supply hitting the market, with new deliveries for the trailing 4 quarters coming in at over 376,000 units, according to CBRE, which was the highest figure on record since 1996, and multifamily vacancy rates have also more than doubled since Q4 of 2021 for almost all classes of apartment units. And along with an uptick in vacancy rates, many markets have also seen material drops in rents at the same time, with metros including San Francisco, Seattle, Phoenix, Las Vegas, Austin, Dallas, and Atlanta all seeing negative year-over-year rent changes in Q3 of this year. Even for industrial product, which has still been performing relatively well over the last 12 months, net absorption dropped by over 35% quarter over quarter in Q3, and total leasing activity has also cooled down significantly, dropping consistently over the last 3 years, down a total of 21% from 2021 levels. Now, new deliveries are expected to level off for most commercial real estate product types starting in about early 2025 and throughout 2026, but in the short term, this could have a significant impact on investors in almost every sector of the commercial real estate industry. And then finally, the last issue I want to cover in this video isn't something I'm seeing being talked about much at all right now, and this is the loss of trust in real estate as an investment vehicle among equity investors that are considering a real estate allocation. A lot of companies that went on buying sprees in 2021 and 2022, especially those companies that finance deals with floating rate debt, are now having to have some really difficult conversations with investors about significantly different performance than they projected a few years ago. And while there is a lot of dry powder on the sidelines right now, the vast majority of these capital providers have at least some allocation towards commercial real estate already. And if these investors are starting to see capital calls on the assets they already own, or they're finding that their equity has been wiped out entirely after buying at the peak of the cycle, a lot of this new capital might be withdrawn from the market, especially with the uncertainty around interest rates going forward. Commercial real estate investment firms are also continually being held to higher standards when it comes to things like fighting climate change, which can substantially increase a company's administrative and compliance costs, and especially at a time when investors can park their excess cash in a money market fund and earn a risk-free rate of return of 5% or more. Companies raising capital right now need to make a really compelling case for a commercial real estate deal that's being acquired or developed in today's market. Now, as with any major changes that go on in commercial real estate, these issues will inevitably lead to opportunities for investors that are ready to capitalize on these shifts. And if you want to make sure that you are ready to analyze deals whenever they come up, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking the CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on current market conditions, make sure to hit the like button and let me know. And let me know in the comments any other issues outside of debt financing that you're seeing in the commercial real estate markets today. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.